Ahead of US inflation data tonight, market bets are firming for a September cut by the Fed. The New Zealand dollar tumbles as markets see a Reserve Bank pivot towards a first rate cut. And there are official rates decisions today in Korea and Malaysia. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner discusses the importance of next week's CPI numbers in New Zealand after a dovish turn by the RBNZ yesterday.
The data could take things a long way in the direction of a cut in November, but there's a lot more data to come before then, including another read on inflation, another read on GDP, and of course labour market data as well.
But first, in 5 and 5 with ANZ. Bets for a September start to the Fed rate cuts rose overnight to 77% from 73% after the second day of congressional testimony by Chair Jerome Powell. While there was little new information, Powell told lawmakers that inflation did not need to go below 2% before rate cuts could start. Stocks rose and the S&P 500 hit 5,600 for the first time, up 0.66% at 4 a.m. Sydney-Melbourne time. US Treasury yields were flat. The key now is US June CPI data tonight. ANZ Head of FX Research, Marja bin Zaman, is expecting core CPI to rise 0.2% in the month and headline CPI to be flat as inflation continues to slow down.
When we look at the ISM Manufacturing Prices Paid Index, we look at the New York Fed's Global Supply Chain Pressure Index, all of that point to disinflationary trend. Similarly, even on the services side of things, when we look at ISM Services Price Paid Index, again, we see disinflationary pressure forthcoming from core services ex-rent inflation. So I think when we get this June data, if it is in line with expectations, clearly points to maybe Q1 CPI was a little bit of an outlier.
The US dollar index was little changed, down 0.06% at 4 a.m. Sydney-Melbourne time. The Aussie dollar up 0.03% at 67.42 US cents. The Kiwi down 0.73% at 60.78 US cents after that Reserve Bank pivot. Number 2, that drop in the Kiwi dollar came after the Reserve Bank held its official cash rate at 5.5% yesterday. That was expected, but it was a perceived dovish pivot, which put markets in a spin. ANZ New Zealand Chief Economist Sharon Zollner says markets were looking for any type of signal for earlier rate cuts that they could lay their hands on.
The Reserve Bank still talked about upside inflation risks, but they definitely acknowledged that the balance of risks is evolving, in particular that some of the high-frequency activity indicators have definitely turned south in recent times. They took out the comment that rates will need to stay high for a sustained period. They just commented that a restrictive stance is appropriate, but hinted that they will, of course, adjust policy as conditions warrant. Now, that's not news, and nor is it news that they are open to changing their minds. Of course, they always are. But the market was very much looking for dovish signals.
Number 3, the yield on New Zealand 2-year government bonds fell 14 basis points yesterday as markets priced in more than one full cut before November this year. The RBNZ's latest forecasts show the OCR on hold until August 2025. Sharon says she doesn't think the Reserve Bank would view what they said as a pivot.
But the market has certainly seen it that way. If that move sticks, then that will cause an easing in monetary conditions, very likely. So the market is certainly doing the Reserve Bank's job for it. And the response is understandable. The data has been weak and the Reserve Bank has confirmed that they have noted that. But it certainly sets us up for an interesting CPI data read next week.
Number 4, the Korean and Malaysian central banks have rate reviews today. ANZ economist Crystal Tan is expecting to see the Bank of Korea gradually shift towards easing. Meanwhile, ANZ economist Arindam Chakraborty says Malaysian rates look set to stay on hold at 3% for the rest of 2024.
The second round effects of the diesel subsidy rationalization are also expected to be minimal. We think the central bank will view any increase in inflation as a one-time adjustment and is therefore unlikely to respond via monetary policy. Moreover, the recent stability of its currency obviates the need for a higher policy rate.
Number 5. China's inflation was 0.2% in June from a year ago, half the market expectation and below May's 0.3%. The annual change in producer prices remained negative. ANZ senior China strategist Zhao Pengxing says that's due to weak domestic demand.
At this moment, China economic recovery is basically export-driven. With the trade protectionism ahead, we expect the domestic demand to play a bigger role in economic recovery in the second half of this year. But June data is not very good at this moment, so policy support will be needed in the second half of this year.
Shell punching there. Now, in our bonus deep dive interview, after that big day in the New Zealand currency and rates markets, ANZ New Zealand chief economist Sharon Zollner spoke to my colleague Alex Tarrant about the importance of next week's inflation data for the June quarter, as well as the shift in outlook for Kiwi and Australian interest rates.
The data could take things a long way in the direction of a cut in November, but there's a lot more data to come before then, including another read on inflation, another read on GDP, and of course labour market data as well, which directly influences the Reserve Bank's estimate of how much spare capacity in the economy. So it's very unlikely that this next CPI read would be enough in and of itself to see the Reserve Bank move forward its estimate of when it'll be cutting by 9 months. That sort of thing happens if you get hit by some hideous global shock, for example, rather than... It's unlikely we'll see a surprise of that magnitude. But I think it is reasonable to be optimistic that it could be a turning point from when the Reserve Bank's been disappointed at the progress they've made to when they're pleasantly surprised and possibly slightly alarmed at the traction they have received and actually realise that cuts earlier rather than later are appropriate.
Just looking at this in light of what's happening in Australia, everyone's talking about Australia hiking and New Zealand bringing cuts forward. There seems to be a shift in the relative stances of monetary policy between those two countries.
So the Reserve Bank of New Zealand was unusually honest about the fact that a recession was going to be the price of getting inflation back to target. Other central banks have sort of hoped to have their cake and eat it too, in terms of maintaining a very strong labour market at the same time as bringing inflation down. That's a really hard thing to do. And the risk with that sort of approach is always that if you go too softly, that the process is going to end up taking a lot longer. And you could end up with high rates for longer than previously. That was the Reserve Bank of New Zealand's conclusion from their 1990s and their 2000s business cycle review, was that they should have gone harder earlier, and then the process ultimately would have been less painful. Now, of course, they were late hiking this time, but they did certainly go for it with, hikes of 75 basis points in one go. And a peak of 5.5%, we weren't sure that was going to be enough, but the data has suggested that it's done the job. The economy is overtly weak. Whereas in Australia, the housing market's looking pretty lively. Their labour market is definitely stronger than here. And most importantly, of course, their core inflation and their domestic inflation measures have been threatening to reaccelerate rather than to fall again. So that's, I think, led to this situation where the market is wondering whether maybe just holding for longer won't be enough, that they might have to hike again. So, of course, that was a concern here in New Zealand 6 months ago, but now I think they're looking at the indicators for spare capacity and for domestic inflation. It really does look like the Reserve Bank is winning, but, it's their job to be paranoid, more paranoid about inflation than anyone else, because at the end of the day, if they hold rates too high for a bit too long, they can cut quickly and rapidly fix that mistake. If they cut too soon and inflation stalls before target, then hauling everyone back for round two is a bit of a nightmare scenario, and possibly a scenario that Australia might be looking at, certainly one that they're worried about at the moment.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, July the 11th. Catch you tomorrow with all the detail on that US June inflation data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.